Okay, so we're going to get back to the nuts and bolts of this. We're going to talk about trust types. The first type of trust we're going to talk about, and these are basically two trust types. There are many trust types, but there are two major trust types or styles where one is revocable and one is irrevocable. And that basically means, well, let's read it. This is also called a grantor trust because the defining component of this trust is the fact that the grantor can revoke or take back anything put into the trust. So a revocable trust is a trust where the grantor can add property to the trust and take property out of the trust. He controls what goes in and out of the trust, at what rate, etc. This means that the grantor ultimately controls the trust, known to the IRS as a grantor trust. So basically any trust where the grantor has control is a revocable trust. It doesn't matter how the grantor may define it or how they may set it up as. The IRS is going to look at it as a grantor trust as long as the person who's giving the property has control over that property ultimately. Okay, and they tax the grantor. And usually these trusts are set up with the grantor's social security number. All right, so just to be clear, this revocable trust, which is called a grantor trust, is a trust in which the grantor has control over the property. Now, this control doesn't necessarily have to be immediate where they can go in and out of the property. The grantor can say, listen, this is an irrevocable trust. I don't have control over it. However, if later on the trustee sells the property and breaks the grantor off with some money, hey, guess what? The IRS is going to say you control that property. You have an interest in it. So we're going to tax you based on that. All right, I don't want to get too far into that, but I just want to let you know that the control by the grantor goes a lot deeper than just his immediate control or allocation of the property. All right. So we said that this is a grantor trust as defined by the IRS. Let's go look at that and see what the IRS defines a grantor trust as and what they consider qualifies any trust as a grantor trust. All right, so we're here on the IRS website and we go here. What is a grantor trust? Right? Grantor trust is a term used in the IRS, the Internal Revenue Code, to describe any trust over which the grantor or other owner retains the power to control or direct the trust income or assets. If a grantor retains certain powers over the benefits in a trust, the income of the trust will be taxed to the grantor rather than to the trust. Now, this is a little misleading because they say it's used to describe any trust over which the grantor or other owner, which would make you think that a trustee who has control over the trust would qualify it as a grantor trust. That is not true. This is in the case of where sometimes they have couples who form trusts and they're both the grantors. So that's what that pertains to. I don't want you to get that mixed up. So if a trustee has control over the trust property and the trust is deemed an irrevocable trust, as long as the grantor cannot benefit from that property or has no control or interest in that property, it is an irrevocable trust and it is not a grantor trust. So I want to make that clear. And here where it says all revocable trusts are by definition grantor trusts. That's what you really need to understand right there. If the grantor has control, it is an revocable trust. All right. So we're going to go back, and that covers the revocable trust. All right. That should give you an idea that as long as the grantor has control over the property, it's revocable. He can take it back. Revoking means to take back. All right. All right. Now I want you to understand also that the IRS makes its own definitions loosely aligned to factual definitions. All right. And we're going to show you that when they describe what a irrevocable trust is. All right. Now, an irrevocable trust is where the grantor cannot change or cannot have control of the property. He cannot revoke anything put into the trust by himself. That is irrevocable. So it's the exact opposite of revocable. And in that case, the taxation is not on the grantor. It is on the trust itself. And we'll get into that a little later on. All right. So now, remember, the IRS says that an irrevocable trust is a trust which by its terms cannot be amended or revoked. No, I'm sorry. That's not what they're saying. They're saying a trust by its terms cannot be modified, amended, or revoked. Period. That's what the definition of an irrevocable trust. And let's go back. Okay. What are irrevocable, revocable trusts? They start off with irrevocable. Okay. An irrevocable trust is a trust which by its terms cannot be modified, amended, or revoked. Period. Okay, they're only speaking in terms of a grantor trust. A private trust, the terms, which is the indentures, your law that you write in terms of how you want your wealth managed, those are the terms that they're talking about. And if you write into your terms, into your indentures, that the trustee can modify or amend the indentures, then it can be done. All right. And we go here to this book. This book is called The Art of Passing the Buck. All right. It is a 600-page book written by Charles Arthur, who's passed away, and also a team of over 20 people, professional people with over 50 years of trust, CPA, and law experience. Now, the IRS sued them in order for them not to write this book, but they defeated the IRS in court. You can look up, or I'll give you some information to look up if you want to go ahead and further your studies on that. This is a very important book. It is considered a Bible in trust law. Okay, very important book. Now, they have trust or irrevocable trust as a trust which by its terms cannot be revoked by the grantor. No, the grantor cannot revoke anything if he's claiming it's irrevocable. However, the trustee can if it is put into the indentures or the terms. So I just wanted to make that distinction. I wanted to give you that comparison to have you understand how the IRS will have you see something as one thing, but it will actually be another. Once you study trust law, you'll start to see the vagueness or indirect way the IRS kind of misleads the initiate, the person who doesn't really know trust law. But if you know trust law, then you'll understand that the IRS tries to give you a different impression and less control of what an actual trust is.